3, 2, 1.
All right, welcome to the show.
Welcome, everybody.
It's going to be a good one. Got a lot of interesting things going on this week.
Do we really?
Yeah, well, in the podcast anyway. I actually put most of it together kind of early in the week, and now it's the end of the week. There's some
things that happen.
That's
usually what happens when we think we got it figured out earlier in the week.
Yeah, no, that's good.
I was just waiting for the snow to go away, which happened today. Thank goodness.
Yeah, it's going to be
rain and
gone today. 70 degrees outside.
Last week we had like highs of 30 and lows of like 11.
Yeah,
today it is like 70 degrees. Yeah. Tomorrow it's going to be warmer.
80 tomorrow.
Time to get on the motorcycles.
Yipper.
All
right.
Just show us what you got.
TSP Weekly Podcast, 28 January 2024. So we're going to, first thing, pretty good article we'll look at. It's the 5 things that TSP does not let you do, kind of in the big scheme of things. And then Recession Watch, obviously, people have been talking about recession now for going on 2 years, and we haven't got there. And are we going to get one? How bad would it be if we did? We'll look at a couple things, a chart about that. And then everybody's been talking about
the 1618.
1618. So I could do a whole thing on 1618. It's the 1618 and the 0.618. It's the golden ratio. Really good stuff. But we've been talking a lot about Fibonacci retracements, and retracements are really, really useful, and they're how much the market will comes back after it falls, right? Or how much will it fall after it's rallied up a lot, right? The flip side of that is you can take the flip side of that and project out how high it might go after it falls. Okay.
Yeah.
So how do some of these people get to projections of, like we said, the I don't know, earlier in January we were looking at what the gurus expect, by the end of the year. And 5,200 is more or less what the average is. But a lot of people get to that number by earnings do this and, fundamentals do that or whatever. But the other way to get there is just to do an extension of what price is right now relative to the last major decline. So it's pretty interesting. That's the thing that changed over the last couple of days. So.
And I think the number, these Fibonacci numbers, anytime anybody kind of asks me about it, first of all, I can't explain it, so I don't try. But all I really do is tell people, I'm like, just trust that math works. Yeah. And because it is amazing how it works. And I think we were talking about yesterday, and I was telling you, I was like, man, I do not understand this at all. But what I know is it works. I mean, I know that the market isn't sitting over in the corner like doing math, right? We don't know that we have these patterns, but we're humans, and it just happens. And whether we like it, we know that from our previous careers. I used to teach a class on this, where bad guys don't realize, or both good guys, bad guys. People don't realize they set patterns, right? Yeah. You drive the same way to work every day. You stop off at the same coffee shop. You do this, whatever it is, right? You even if you're trying not to. You still go in patterns. And so that's because I know that's why I accept. It
makes sense that it works.
Yeah, I accept this other thing that's, much bigger in scale. But, you just got to trust that works. And when you look at these, so the reason why I'm going on and on about this is when we get to it, don't tune out if you're watching this.
This is the best part of the show. The podcast.
Don't worry about why.
Yeah.
Right? Don't worry about Fibonacci and math, and some of you guys maybe if you're a math nerd, math guru is probably a better way to put it. You'll love it, right? But most people don't want to think about all that. But just trust that these levels, and it's really easy to do in a chart program, whether it's TradingView, what we use, to put it at the bottom, drag it up, and then all of a sudden you've got these known levels that you can kind of make your decisions off. Right before we started the podcast, I've been playing around with a few stocks, again, more for learning, right? So I don't have a lot of money in there, but it's stocks that I know that they're doing something that I can kind of wrap my head around. Mm-hmm. And so trying to get better at this. And we were talking about, what rules would I use to get out, right? And this is like one of those things you could use. You could just layer that on top of it and say, okay, if it bounces up against that resistance level, that 1618, it never goes above it and then kind of drops down, maybe it's time to get out. If it cracks through that, the next one is 2618, right? And it's a pretty good jump.
Big jump.
Anyway, I think they're a great tool, and you don't have to understand the math. All you got to do is just put it on there.
Yeah.
Put it on there.
No, we got plenty of examples of them.
Cool.
Yeah, that's definitely the best, the chunk of the podcast here. So 5 things TSP does not let you do. So this was a pretty good article in Fed Week. It was published on January 1st. So I'm not going over everything in that article, so it's definitely worth taking a look at it. But the 5 things that TSP does not let you do. So I see some of these questions all the time in Facebook group. There's no Roth conversion in TSP, right? So if you're moving money from pre-tax to an after-tax account, you can't do it in TSP. You got to roll to an IRA, and then you can do the transfer, and you can have a separate traditional and you can have both a traditional and a Roth in TSP, but you can't convert your traditional to a Roth. Whether they just decided not to make the mechanism possible, you basically have to pay the tax to do the conversion, but you can't do it in TSP. You have to roll into an IRA first, and therefore that money is out of TSP. So no Roth conversion. Really tedious spousal consent. So I didn't make this up. Basically anything you do, not anything you do, any kind of withdrawal, transfer, any kind of moving the money, not reallocating, but moving the money, you have to have, if you're married, you have to have your spouse's consent to do it. But on the positive side, you no longer have to have it notarized. You can do it via email. They talk about it in the article exactly what you need, but it's no longer required that it's notarized. You can't pick which investments to sell. So if you want to, say you're retired and you want your 50C, 50G, and you're getting $1,000 a month, let's say, withdrawal from TSP, and you want it all to come out of the G fund, you can't do that. They evenly pull. Every time they do a withdrawal, it comes out evenly distributed to whichever funds you're in. It would be great if you could, tell them where you wanted it to come from, but you can't do it. Mutual fund window is not part of that. So if you have money in the mutual fund window, it does not. They don't pull from there. They're only pulling from the core TSP.
Which tells you they could if they wanted to. Yeah. They could do some of these things.
100% they could. Yeah.
Yeah, it's not that they can't. They won't.
Yeah. I still haven't heard back from the Congressional Affairs guy. I'm kind of surprised because he was pretty quick to get back to me the first time. And
he's probably like, why does this guy go away?
Oh, I'm not going away. He's got until next week. Yeah. Can't change how much tax they take. So if you are making withdrawals from TSP, they withhold 20%. If you're, I think you could probably have them withhold more if you wanted to. I don't know. I'm kind of making that up. I know they withhold 20%, and then pretty much you have to sort it out at the end of the year with the tax guy. You either have to, you'll get some money back if you're in that under 20% tax bracket. Or
they don't try to figure out your tax bracket.
No, they just take 20%.
They just take 20%, yeah. Which I think is a smart way, because how are you going to do that? Right. There's too many ways for it to get messed up one way or the other, and say, look, we're just going to take 20%. If that was too much, you'll get it back. Yeah. If it was not enough, you're going to pay in. And I think that's a sweet spot. I actually don't think that's a necessarily bad thing.
No, and it makes it
better than 30%.
By a lot. And it's fine because it makes the numbers pretty easy for your tax guy to figure out. And they do a good job at the end of the year with, if you're retired, sorting all that stuff out that you can give to your tax guy. And then the last one is no QCDs, so qualified charitable distributions. They say it's the best way to give and save on taxes, right? That's why I put that in there as A. Basically, if you're in this required minimum distribution group, so you're over I think it's going to 75. I think it's 72 now, going to 75 years old. But you can make required minimum distributions without paying taxes on that. So, which basically means if you have to say it's like $2,000 a month that you have to take because of required minimum distributions. If you put that money into a charity directly from there, you're not paying taxes on that, right? If you took it as income, you would have to pay taxes on it. So, if you're planning on doing charitable contributions anyway, it's pretty awesome if you use your RMD money and not pay taxes on it, and that's the part that goes to charity, and then you get but you can't do that from TSP. It's got to be done from an IRA. So the crux of one of the points of the article was the value of staying in TSP once you retire, because there are definitely some things that you can't do in TSP, namely these 5, among others. But for us, the biggest one is you can't move your money the way you want. I mean, it's you still got the 2 move a month rule and everything else, the noon rule. So rolling into an IRA, I think, gives you a lot more flexibility for a lot of different reasons.
It does, and if you're actively managing your retirement account, which is what we would definitely suggest, right? We're on that side. It's a no-brainer to move at least a significant portion of your TSP over to an IRA, whether you manage it or not. Like, let somebody else manage. That's the good part of it. Let's say for years now you've been managing your TSP. You don't really want to do that anymore, actively managing it, and you're like, hey, I'd like to turn this over to a money manager, somebody that does this for a living. You can't do that in a TSP, right? Move that out of the TSP, put it in IRA, let somebody else deal with it. Maybe they're better than you at it or whatever. You just don't want to fool with it because you're retired.
Yep.
And then, potentially leaving some in there, mostly for access. Yeah. Right, if you're not at the right age,
it depends on the circumstances.
Yeah, all that depends on the circumstances. But leaving it all in the TSP is a very odd.
It's simple. The simplicity is what.
Yeah, if you're not actively managing it, and you have all of your retirement money in G, right? So it's safe. It's still getting a few percent a year. Yep. That's not a bad deal, right? That's a good deal because you're not going to get that. You're not going to get a money market account. It's going to be rare for you to get what the G fund would give you, right? And by law, it can't go negative. Right. So that's not a bad deal. That's probably the only way. Like now, leaving like 50C, 50G, like 50% of your account can just disappear.
Yeah,
that's probably not a great idea if you're not actively managing it, right? You're just passive,
right.
Like not doing anything with this.
I mean, the best thing would be if you could grow it big enough that the rate of return of the G fund is enough for you to live on.
Yeah, that would be magic.
Yeah, because then you basically, it can't go negative by law. So right. As long as you keep your standard of living in that couple percent, it grows, and there's no risk. Not too many people grow their TSP to that level, I don't think. All right, recession watch. So this is a chart of the 10-year Treasury minus the 2-year Treasury. And it's kind of the standard that economists look at to try to predict recessions. Okay, so when they say the yield curve is inverted, right? You probably heard that term. Inverted yield curve means the 10-year minus the 2-year is below the zero line. Okay, that's what an inverted yield curve is. And so back here in the late 70s and 80s, we had the yield curve was up and down above that zero line quite a bit. And we had recessions, several of them throughout there. You don't get an inverted yield curve very often, but every time you get an inverted yield curve, you get a recession. But it's not the inverted yield curve, it's when it uninverts. So you get an inverted yield curve here for a while. It gets back above. When it uninverts and starts moving in the other direction, that's when you get these are recessions. 1990, 2001, 2007. COVID was a little bit different, sort of. I mean, we just barely got down to that zero line. You could kind of take COVID off there because everybody's going to say, well, it's because we shut the economy down, and there's some truth to that. But it looked like we were heading towards a recession anyway. But now we've been in the most inverted since the late 70s, early 80s, the deepest and the longest. Okay, so what's been happening in the last 6 months or so is the yield curve is starting to uninvert. So that's on a lot of people's radars, but we're not there yet, right? We're really not. It could jump pretty quick, but it's going to take some time to fill that gap. So a recession is unlikely to happen in the very near term. It could be this year, but it's almost unlikely that it's this year, based on this chart, because it takes some time. It's got to uninvert above that zero line before the recession really begins. Doesn't mean that's when the market starts rolling over. So here's a chart of the S&P 500 when we're going into recession and out of recession. So like back on this one at 75. So let me back up. This is a logarithmic chart. Okay, so what that means is the distance from, say, this top to this bottom is the same distance as this top to this bottom. Okay, so what that's telling you is from here to here was a 50% loss in price, in value. We know the from 2000 to 2003 was a 50% decline in the C fund. You also had a 50% decline back here in the 70s, right? This one was a 55% decline. It's a little bit longer. So it's a logarithmic chart. So if we had a 50% decline, today it would take us basically something like that, because it would be the same. It would be the same length on the chart as these. So recessions. The market already started rolling over here pretty significantly before we got into recession, right? And had already started ticking back up before they said we were out of the recession. This one was pretty deep in terms of stock price falling. This one, not so much, right? Maybe 20%, not huge. This one, maybe 30%, right? If we're looking at it all relative to this distance as 50%, these little ones aren't that big a deal. And we got a bunch of little ones. The problem, this was the recession, and the market can still go down. So we can have big moves down in recession, or we can have little moves down. It's really it's tied to GDP, not stock prices. So you can have. I mean, the 90s was pretty shallow. Where's that one? This recession was pretty shallow. It still counts as a recession, but we didn't have this big move down in price. Whereas these two, we had big moves down in price. And COVID was big down in price, really the shortest recession ever, right? It was like a couple of months long. So all I'm trying to say is, don't let the recession boogeyman basically freak you out, because just because we have a recession doesn't mean that stocks have to plummet. It can easily go sideways and work through those recessionary conditions, and then we keep on going higher. Okay, so the 1618 extension. We did a pretty good intro into it there a while ago, so let me just go through a couple of historical examples. So here we are at the top in 2007, right? Top in the stock market. And all we do is draw from the bottom to the top using the Fibonacci extension tool, and the tool puts in these lines, okay?
Yeah, the tool basically is use your mouse to kind of click and then drag.
Yeah.
So you click at the bottom, and then just, for everybody else, that's how you use that. So it's pretty simple.
Yeah, it's simple. It does the math, obviously, behind the scenes, and it puts the lines on there for you. And so what happened? We had a big move down from the top in 2007 to March 2009. And when you put the tool there at the bottom and you extend it to the top, it gives you can put the different Fibonacci extension levels in there. So I could cross these out if I wanted to, and the lines wouldn't show up. But I just left them there for the purposes of this. So 1618 extension gets us right into this churning. Okay, so the 1618 extension is the most common extension. And so it doesn't mean the market's going to roll over when it gets there. It just means that it's going to hit resistance. It's a level that you should pay attention to because you should expect some resistance there. It's possible that it hits that extension level to the tick and rolls over. But that, you can't know that. So what you can know is when you're back here, you're expecting price to get at least up to that level. Once you get really above this high, now you can use the tool and say, all right, we could have some churning, but I'm expecting price to get up to that 1618 level. Okay, and then what happens after that, you have to work with it. So here's another one from 2010. So I did top in 2010. This was about 6 months later, so that decline was about 6 months. Once you get up here and get above that prior high, you can use the extension tool to figure out how high you're likely to go, which is that 1618 extension, and it hit it exactly to the tick. And then we had a pretty big decline from there. If we go to 2015, we get a high right here, we get a low down here. The 1618 took us right to that churning, right? We went sideways for a while and then kept moving higher. So it doesn't mean the market's necessarily going to roll over there. It just means that's a resistance level. It's a target. Okay. The 2018 was kind of a rough year. We get to the top here, the bottom, and do that extension, and it took us to right before COVID. I mean, I thought that was kind of fascinating. I mean, literally right to the tick, and then COVID happens. Obviously, it's coincidental, but it's kind of amazing that it does it right to the tick. My eraser's not, there we go. And then if we move in a little bit closer, so after COVID, right, we get the top in COVID, the bottom, pull it out to that 1618 level, and you get that resistance, right? Doesn't mean the market's going to roll over there. It just means we were going basically straight up until we hit that line, and then we have some pretty significant resistance there. I mean, the market did go a little bit higher before it finally rolled over in 2022, but that was a great target. If you were back here and you're like, all right, once we get above, here's the top from COVID, there was a bunch of churning to get through that prior high right here. And once we got above that prior high, how high are we likely to go? Well, 1618 is a great target. And we get there, and we have some more churning, right? It's a really valuable tool. If you look at a couple of more short-term ones, this is from 2021. So how do you we had a peak here in May of 21, a pretty good collapse for a couple of days. How do you figure where the next, if you're doing the short term, you do the 1618 and you get up to this level, you get a bunch of churn, the market rolls over. Yeah, it keeps going higher, but you have churn here, a rollover. So if you were trying to project to where you wanted to get out, like that's what we were talking about earlier about Conan looking at those stocks and figuring out where would be a good place to get out, you would use that 1618 level. Say you got out once it hit 1618, and then once it gets above it, you get back in, something like that, because you're past that resistance level. Same thing here. I just put two short-term ones on the same chart, but we get that top, have this bottom. It runs up to that 1618 level right there, and that was kind of the beginning of the end into 2022. Okay, so that's like historical views of how they work. So what does the current projection look like? So here's the top in August last year, and the bottom in October from last year. And all I did, same thing we've been talking about, from the bottom to the top, just pull the Fibonacci extension level, and that's how you get up to basically 49.50. Okay, so we're looking for the C fund to get up here to about 49.50. That's the next place that we would expect some kind of churn. It could, reverse and go lower from there. It could blow right through it and keep on going, which would be very bullish. But we're expecting some kind of churning to happen at that level. Okay. This is from a couple days ago. This is from January 22nd. So I redid it this morning, and I did it with a line chart instead of candlestick charts. Candlesticks gets a little bit tricky if you're not used to it, because it's not just closing price, it's what's happening intraday. So if you just use a line, this is what it looks like. You got the high from August, the low from October, you do the 1618, and as of Friday, morning, we are really close to that 1618 extension. Okay, so over the next couple of weeks, should we expect to get up here and at a minimum some kind of churning for a while there? A lot of people are expecting a pullback into March, and so to get that extension into the end of January, beginning of February, and maybe we get a pullback into March. I mean, it's consistent with what people are expecting. And the fact that we're basically almost at that 1618 extension is kind of remarkable, I think. So why the math works, I have no idea. Why the pattern works, don't know, but it certainly works. Okay, I got one more. So a long-term projection. So if we did the top in 2022 to the bottom in October 2022 and did the 1618 on that, this is where you are. This is how you get the melt up scenario that there's a good handful of people talking about. So you're at the prior high, which is where we are right now. We're churning, trying to break through that prior high, okay? And we got through it last week. So the next, the projection, the 1618 projection is, almost 6,000, 5870 and 5880 basically. That's how you would get there. That's how you're projecting out to get there. Doesn't mean it's going to go in a straight line, but before you get to the next major resistance level, you're looking at 5,900 on the S&P. And I'm doing a little bit more in-depth extension charts in the newsletter this weekend. So if you are a subscriber, definitely check it out, because I'm going to assume that you guys saw the basics here in the podcast, but I've already done the more of a deep dive into the short-term and the long-term projections for the S&P. All right, C-Fund chart. So before we get to the chart, I just wanted to, so the CCI is one of the indicators that we use in our stack, right? CCI developed by Donald Lambert for commodities, right? He wrote it in Commodities Magazine in 1980. It's basically used to identify trends in the commodities market, but they figured out that it also applied to indexes, ETFs, stocks. So in general, CCI measures the current price level to an average price level over a given period of time. When CCI is relatively high when prices are far above their average, but is relatively low when prices are far below their average. So the CCI is used to identify overbought and oversold levels. If you want to learn more about it, the article is much longer, but and basically everything you want to know about technical analysis in school.stockcharts.com. So just with that as an intro, this is the CCI indicator down here. And this is a weekly chart of the S&P 500 C-Fund. So basically two things to point out. When CCI on a weekly basis gets oversold, so oversold, the bottom dotted line is minus 100. The top dotted line is plus 100, and 0 is in the middle. So on a weekly basis, when CCI gets below negative 100, it doesn't happen very often. Okay, we're going back to 2016 here. So it doesn't happen 1, 2, 3, 4, 5, 6, 7, 8, 9 times since 2016. When CCI gets below negative 100 on a weekly basis, it's pretty oversold. Okay, so you don't want to buy it when it's oversold, because if it gets down there, it can go lower, right? So if you buy it after it gets down there and ticks back above that negative 100, it's likely to keep going in the same direction, right? It's an early indicator. And so what I did was on this, I put the green vertical lines when CCI got below negative 100, turned back up and got above negative 100, right? And you can see it's an early, it gets you in really close to the bottom of major moves. Okay. Can there be head fakes? Absolutely. In 2022, we had them quite a bit, right? You can see down here, it kept getting oversold because the market was in this, big move to the downside. But for the most part, when you get below negative 100, it's an indicator that you should, it's a kind of a flag that you should start looking to get back in. And this is only one indicator, right? We have a stack with 5 or 6 indicators that we use, and you want to have overlapping reasons to get in and out. But this is just a really simple example of using just CCI to get you to think about when is it time to start getting back in. Because what happens is, like at the bottom of COVID here, everybody is like panicking, right? The market's only going to go lower. Well, that's true when you're here. But once CCI turns back up, even if price is continuing down, you want to be looking to get back in. Okay. And as far as the week, I mean, you can see right now, CCI is overbought. It can stay there. That's the other thing about CCI. It's really good for picking bottoms. It is not good for picking tops. So you wouldn't want to say, okay, well, the inverse is true then. When CCI gets overbought and then starts heading down, I want to sell it. It doesn't work so well as a topping indicator. You can see how long it can stay overbought and price keeps moving higher. So what it's really good at is picking significant bottoms. Okay, and as far as where we are right now, on a weekly basis in the C fund, we're basically in a melt up. I mean, we've had one down week since October of last year. It's kind of unbelievable with all the stuff that's going on in the world, and we got above the prior high. And we talked about the projection, in the last section. So we're looking for the C fund to just keep moving higher up to that next 1618 level. Doesn't mean it's going to go there in a straight line, but if you're a weekly buy and hold person, or a weekly, follower of your TSP funds, there's no big reason for concern right now, I would say. Okay. If you want more in-depth education and analysis, yada yada, we do a lot more of the daily stuff. And this weekend's newsletter actually is good. It was somebody had put in the forum, I think members only forum, about now that the S&P 500 had exceeded the prior all-time highs. What's the Elliott wave, the new Elliott wave count? Because there are Elliott waves, there are always a primary count, and then you have a couple of secondary counts. And once a primary count gets invalidated, then the next count kind of moves to the primary count. And that's basically what the newsletter is going to be about this weekend. Questions?
If you have questions, put them in the comment section where you find the video, whether it's on social media or whatever. If there's not a comment section where you find the video, then you can just shoot us an email at support@growmytsp.com. If you like the show, please share it with your friends. If you don't, share it anyway.
Share away. Oh, and they always say on all these, well, if you're watching on YouTube, what do they say? Hit the like and the subscribe.
Hit the like and the subscribe. Yeah, we never tell people to do that. Do it anyway. You should do it. Yeah. All right, guys. Hope you have a great week, and we will see you soon.